And for that, I'd now like to invite on stage Mr. Bhushan Kedar, Director Funds and Fixed Income Research with Crisil Limited. Ladies and gentlemen, he's someone who's armed with more than 16 years of prolific experience. So let's have a huge round of applause one more time. Please help me welcome Mr. Bhushan Kedar.
Yeah, hi, good afternoon, everyone. I think the first thing that struck to sort of my mind really is a full-day conference on passives. And that's happening here in India. That's, I would say, wonderful feat. And I think when we get into numbers, we'll start connecting why. And it is here to stay. I think that's an important thing. So I would like to thank Cafe Mutual to invite Crisil on the platform and share our perspective. So I will pick up a thread from the last presentation. Of course, I don't have slides, so I'll talk about some of the key trends that we are observing and what are the aspects that we believe will unfold in this space when it comes to fixed income investing through passives. So clearly, I think goal planning, it's something which, essential part of the overall financial, I would say, planning process for every individual. There are targets. It could be wealth creation, or there could be specific targets, right, from maybe buying a vehicle, house, or so on and so forth, a holiday or something. I mean, it could be multiple things. Then how do we really achieve those targets? So certainly it starts with risk profiling, and one really wants to focus on how do you get into doing an asset allocation for an investors, and then once the investment decision is taken in terms of asset allocation, then you go to a fund or a direct investment. Could be equity market, could be debt market. So those are the options actually become important. Now, specifically focusing on passive itself, which has, or rather, pooled investment, which has become a very important vehicle for investors over the period of time because of professionally managed services that are really offered. And as what we have seen really is it is becoming more and more competitive as we see in terms of fee structure, or for that matter in terms of product offering. So certainly investors would want to look at that as a critical part of their investment strategy ultimately. Globally, and I'll start focusing on ETFs now. Globally, 10 trillion is what we see on index ETFs that has really touched over a period of time. Maybe $500 billion was debt ETF probably 8 or 10 years back. Now it has crossed about 2.5–3 trillion in recent past. So it has achieved significant scale. In India till 2019, debt ETF didn't cross 2,000 crore for a very long period of time. But I think after launch of Bharat Bond ETF in 2019, now we are talking about size of about 95,000 crore to 1 lakh crore, which the debt ETF has touched, and overall market is about close to 5 lakh crore, as the recent number sort of suggests. So passives are growing significantly, and debt as well is claiming its share in the space. Now, how did we sort of get there is the first part really. On the back of some of the credit concerns that we saw maybe 2017, 2018, so the risk aversion sort of set in investors' mind. So there was certainly a need for looking at more stable, clear, maybe predictable yields, predictable portfolios. I think that is what was becoming a need for the investor. So that probably was the starting point, I would say, that point of time. With Bharat Bond ETF, of course, it gave a platform to products of this nature. Clearly, what we also saw is creating portfolios with to begin with in this space. What we saw is since the risk appetite was lower, so government securities, state development loans, or for that matter, AAA PSUs were the starting point and the strategies that investors were sort of certainly open to, and that is what got launched. Indian investors, retail investors, have been comfortable with fixed deposit as a product, and if you actually look at the data, 50% plus of the savings of Indian investors typically go into fixed deposits. That's traditionally the number that we've been tracking. Probably it's been ranging between 45 to 50, 52%. So there's large chunk of savings has been going to fixed deposit. Now, what could actually replicate fixed deposit or like product on the mutual fund platform was the target date or target maturity products, and that's what we are seeing here right now. And this is where we are seeing on risk-free assets like GSEC SDL, or for that matter quasi-sovereign like AAA PSU are taking place. So that's one element, and that's how the product started picking up. What we are additionally seeing besides the products actually have advantage over fixed deposit, maybe from the perspective of capital gains, and that is one area where it scores above. But over and above that, what is really important, if one has to really see the yield itself on any portfolio over a 3-year or a 5-year or a 7-year horizon, it certainly offers anything between 20-30 basis points to about even 100 basis point over and above the fixed deposits of maybe large public sector banks that we really talk about. So that's clearly an advantage with capital gain advantage, tax advantage that really exists for the investor. So that is something which is making the product certainly more lucrative. That's one. Two, as we compare that with the traditional active products on the debt side, where the for typically medium duration funds or long duration funds, the expense ratio ranging from about 100 basis point to about 150 basis points. Some could be on the lower side, but that's really the range. The passives on the debt side are the expense structure is ranging between 11 basis point to about 30-40 basis points. So that's about 100 basis difference clearly that exists, and this is something which is per annum. So that is another strong advantage that investors have been sort of has certainly appealed to the investors at this juncture. So that's a very critical element from a decision making standpoint. The other element, and I was also referring to the fact that in after 2017, 2018, or for that matter even when COVID really hit us, there was risk aversion that really set into investors' mind, and that was another reason why investor, or for that matter even intermediaries, wanted comfort on the portfolio construction process itself. So what is going inside the portfolio in terms of asset allocation, in terms of security selection, in terms of credit rating profile, in terms of maturity profile, duration, I think all of these advantages or all of these aspects were clearly disclosed, and that's really a strong benefit of index product, where a index document or a portfolio document is really put out. All of these details are available for someone to see, and not just that, on a daily basis, if the investor wants to track what is there in the index portfolio today in terms of the allocation, security selection, weightages, I think all of that is clearly available for investors to see, and that gives them a far better perspective in terms of risk that they are really running on the portfolio. And given that the rules are already set in advance, you would typically know that this is how the portfolio is going to get created, and for an investor sitting today will obviously get to see the yield as well, that how the portfolio is going to generate. Obviously there could be inflows and outflows that typically may have an impact on the portfolio yield over a period of time. So maybe the starting yield, and there could be some divergence on account of inflows and outflows, but largely it gives a strong sense. And at any point in time, and as of course, as we are seeing, people are also looking at investing in products like these in a SIP sort of form, which probably was unheard earlier. Now this is another trend that possibly we are seeing. It just sort of began. So that is another element, and I think that is what has really attracted investors to the space, and these are clearly advantage. And I probably would now step back a little and talk about how exactly the products actually get created, and what is the role of a regulator or regulations or policy that really plays out here. So in order to create any index fund, and I think the speakers have already spoken before in terms of indices are there and indices have to be sort of replicated. On equity, I would say it is to a great extent possible, especially on the top 50, top 100 side, because there is decent amount of liquidity that we see. But debt market per se are illiquid by nature, and if I was to just give you a number, there are about 150, when I'm talking about corporate bonds, there are about 150 ISINs get traded out of 25,000 ISINs that are outstanding. That's corporate bond. On the government securities side, though government securities market is more liquid, and there, I would say, a good amount of perceived liquidity that also exists. But if you were to really look at the trading volume, the top 5 securities, government securities will typically have about 80 to 85% trading volume just among themselves. So in that sense, there is a skew. There is clearly lack of liquidity on the other hand on the corporate bond market. So it's an important task to create a replicable portfolio, and I think that is where the index providers like Crisil sort of comes in, and that's where we create portfolios. The sole objective is, one, clearly create portfolios that are replicable. So be it GSEC, be it state loan, or for that matter corporate bonds, look at issuers that are liquid, look at issuers or within that the ISINs are liquid, and two, there is good amount of depth in those securities or for that matter issuers. So for an example, if security has outstanding of about only 200, 300 crores, possibly you will not be able to find the bond itself. Hence it is critical to look at a number which is more feasible and replicable in that sense. So create portfolios that are replicable. One good thing about the debt portfolios is, or rather debt index fund is really partial replication has been allowed, especially for state loan ETFs or index funds, or for that matter corporate bond index funds. So you can actually pick up of any security of that issuer with that sort of a maturity profile. It need not be same ISIN, so that gives far more comfort from a replication standpoint, and obviously it also gives comfort to the investor because the risk actually doesn't change if you were to pick up another security instead of the security that is part of the index, because the yield typically would be sort of similar. So I think that is one exercise, if you ask us, really goes inside in sort of creating that. Some of these strategies, when we are looking at indices, we sort of backtest them and see how over last 1 year the portfolio would have performed, maybe last 3 years how it would have performed, and not just from the perspective of yield or a performance number. The other aspect also needs to be looked at is liquidity. How through different phases the liquidity has really performed, a weekly liquidity number or a monthly or a yearly liquidity number. So I think those are the contours that really gets focused on. And besides that, an important role that SEBI has been playing is the rules for passive funds. Though there was a mention of passive fund on the debt side in 2017 categorization circular that came by SEBI, where it spoke about, say, 95% replication, and that is applicable for GSEC funds. In 2019, there was another circular which allowed partial replication for SDL and corporate bonds. That gave sort of further clarity. And even if you see the process today, so besides what has been put up there in the regulatory framework itself, what we are really seeing is there is sort of continuous, I would say, monitoring by SEBI in terms of the documentation that are filed. There is as much of transparency and disclosures that are really warranted for the investors that is necessary. I think SEBI, we have seen, taken every effort to sort of look at that. So if I was to just quote an example, if you actually look at the fund name nomenclature itself, it will give you a clear picture of where the fund is going to be sort of, or the index is going to be investing in terms of asset allocation, and in terms of course, security selection process. If you go through the details, and there could be a typically a half a page or a 1 page about what is the investment philosophy, asset allocation, review frequency. If you go through those details, you will be able to get a complete picture of what exactly index is going to be constructed and maintained. So I think those are the elements that really sort of go in when you are creating, when the index actually gets created. And what we have seen over last 1.5 year of passive on the fixed income side, clearly the tracking error is the most important part, and we are seeing that it is ranging between about 30 to 45 basis point. At the initial part of the fund launch, maybe for first quarter or something, the tracking error could be relatively higher at times. But as we get into maybe thick of things and replication sort of becomes far more seamless. So at least whatever strategies in the back end from an index creation perspective, replication perspective have been sort of creating, that clearly are working well. And the idea will be to really get into more strategies as we go along. Now, as we are still in the phase where we are possibly seeing the risk aversion is still in place, there is other issue that we are also seeing because of the high deficit numbers. The supply of government securities and state loans are remaining elevated. So in a way, it is crowding out the corporate bond supply per se. So there are limited strategies that are taking place on the corporate bond side, and we believe as and when the market really picks up, the supply really picks up, more themes to come by. And so some of those things we could sort of talk about is something on the ESG side, or one was to pick up something on the NBFCs, or for that matter housing finance, which are sort of prominent issuers in the space, and we possibly may see more and more themes to come in. And I think that is what possibly we expect to be sort of a way forward, and that will give enough and more opportunities for investor to diversify. It will also give them the yield kicker or the spread kicker that they would typically want, where we are today operating for a government security, which is say about 7 quarter for a 10-year, and if you were to look at a lower maturity about say 7%, and SDL being about 740, 750, and AAA being about 780. So I think anything north of that for a maybe 3 to 5 year horizon, what it will typically offer for a target maturity products could be about 50 to 100 basis point over and above that if you were to really look at some of these portfolios. So I think that is something which is sort of going to come, is what we expect. In terms of rate, view, or that Crisil really holds at how interest rates and supply of some of these securities that are necessary to fulfill demand for the investors, be it on GSEC or SDL or corporate bond, that is really expected. So if you really look at from the perspective of deficit numbers, of course, government is looking at a trajectory of fiscal deficit will taper off over a period of next 3 to 4 years. So till then, we expect the supplies, government security supply to be, I would say, abundant in terms of given the demand for both insurance players and provident fund players who typically have large allocations to that. But even after meeting their demands, we expect surplus supply to be there to meet the demand for this product. So replication related challenges on that front could be sort of limited. So that's one part that we are really talking about from a supply perspective. The second piece is really on the interest rates. So today I spoke about the rates that we are talking about 7 to 7.5% is the range for 10-year GSEC. Tactically, it could go up, and it is going to remain possibly over next 3 to 4 years between 7 quarter to about 7.75 is the broad range that we are talking about. Tactically, it may go hit 8% and maybe come back, but that's how we are looking at it. So the rates per se are expected to remain certainly elevated, and state loans or for that matter bonds will typically carry, and traditionally what we have seen, they typically carry spread between 50 basis point to about 75 basis point for PSU bonds, and you basically add about 30 to 50 basis point for issuers like HDFC, which is housing finance sector, and add another 25-30 basis point for entities like Bajaj Finance, which are on the NBFC side. And obviously, some of the other issuers in those space will typically be having, some additional spread. So those are the kind of yields or HTM strategy that one could really be looking at. And the other important element that I just thought, besides the target maturity profile that we've been a lot focusing on. On the other hand, platforms which are sort of open-ended platform and running, funds without target maturities, clearly they would sort of come in provided there are a couple of actions, policy actions, and I think all of them are in pipeline, I would say. So for an example, last year when the finance minister announced there is going to be a support on the market making side, or there would be initiatives that would be taken on market making side. So we believe there is some action possibility that is taking place. So that will help liquidity on the corporate bond market side. So if today the challenge really is one, to get a supply of bonds on a timely basis, or get exit from corporate bonds on a timely basis at a right price, or at least known price. So if those elements are sort of taken care of, then we'll clearly see this market getting that support. And I think that is one initiative as and when, and we believe that it may possibly come sooner. And that is something which will help creation of those open sort of non-target maturity platforms to sort of open up and help investor get that sort of choice to really make from. So we clearly at Crisil, just to conclude, we clearly believe that passive products have over a period of time, globally and now locally we see, are giving that sort of choice and comfort to the investor because of multiple factors that I spoke about in terms of visibility, transparency, and consistency. That is something which is offered to them. And of course, from a cost perspective, they are certainly far more efficient. And in India, the debt market is in sort of evolution stage. We possibly are seeing, maybe hiccups because of post-COVID world. Till the time economy revives and some of the macro factors sort of come in place, in right place, there could be this, some of these aspects that we are really talking about, or factors may stay. But in the long run, we clearly feel this is a place which will offer a lot of opportunities for the investors. And this is something which we believe is clearly here to stay. So thank you very much for patient hearing. Thank you, Cafe Mutual, for allowing us to say.